Hello, this is Matthew Erskine. I just wanted to go over trying to learn from the past. We are looking at the possibility of having the estate tax exemption unified credit drop from the $13 million it is today to approximately $5.5 million as of January 1, 2026. This so-called fiscal cliff is something which should be familiar to those who were involved with estate planning, either as a client or as a professional, in 2011. Because at that time, during the Obama administration, there was a similar fiscal cliff, and the tax exemption, which at that time was $5.5 million, was going to revert back to what it was in 2001 at $1 million. This led to a lot of planning where clients were urged to fund irrevocable asset protection trusts, which they could not get access to. And then in January 2nd of 2012, President Obama signed a bill which extended and actually ended up increasing the exemption, and so all of that irrevocable trust planning was for naught. We're going to probably see a lot of planning that's going to try to take advantage of the $13 million between now and the 1st of January 2026. And I think we need to take a hard look and see if we can learn from the lessons of the past. And there are several tactics which you can use that allow you to qualify it as a gift and so preserve the credit, but still have the client be able to have access to the assets either directly or indirectly. The first is the so-called spousal limited access trust, in which one spouse makes it for the benefit of the other spouse, but has limited access to it through the terms of the trust. The second is what's called Qualified Personal Residence Trust, or QPERT. This is a trust which you put the property into a trust that is for your benefit, and the remainder goes to your children or other heirs. And in that case, there is no gift tax, and if you outlive the term, like 10 or 20 years of the QPERT, then the assets will go to the heirs tax-free. The third way that you can do things is a loan to an intentionally defective grantor trust. Now, the loan to the trust, basically you sell assets to the trust and take back a loan. That loan, if you needed to have money, could be accelerated. That is, that the trust or the trustee could pay you additional monies that you would have been more than you had been owed under the terms of the note when there was a financial hardship. The final way that you could do it is to create what's called a dynasty trust, which essentially is going to take the unified credit and make sure that those assets never get taxed again, even multiple generations down the road. There are some significant issues with creating a dynasty trust, but it is one of the tactics that is available. My recommendation is that everyone should take a long, hard look at their estate plans and decide whether or not some of these tactics might be worth considering. This has been a summary of the article which I posted on Forbes magazine and my page in Forbes. And if you have any questions or would like to have some of these plans, please feel free to get in touch with me. Thank you.